Hi everyone, it's Jack back with another video. Today I'm going to be talking about a company that everyone knows, PayPal. It's up 450% from its 2015 spin-off, now a $220 billion market cap company. That fabulous stock to own of this period, of course. Stock prices fell 38% from its all-time highs in the last 6 months. Company is no longer the hyper-growth stock it once was, but it's certainly no slouch in the growth department. Has incredible tailwinds with the shift towards digital payments, and has an absolutely enormous total addressable market well into the trillions. The question is it undervalued today? Looking at the quality of the business, that's a really strong value proposition for both sides of PayPal's business. It's a two-sided network for merchants. Payments are seamless with a ton of tools and insights into customer sales and analytics to get access to buy now, pay later, credit solutions, and most importantly, the trust and fraud security of an international 400 million plus member network. For consumers, PayPal is essentially building a super app. It's fee-free, secure, has buy now, pay later options, crypto investing. It's an all-in-one solution that is free for the most part. It's extremely convenient, especially with the growth of Venmo. Honey is also a great offering for consumers. It has a true network effect with its two-sided network. Relatively high switching costs in terms of time. Once you're in with a couple of PayPal products, you're more likely to use more. It's quick, it's easy, it's reliable, and this creates fantastic moat and again, really high switching costs. PayPal nowadays is ubiquitous. PayPal checkout is available at 75% of the top 1,500 North American and European retailers. Absolutely incredible exposure. Relationship building with merchants is excellent and is only improving customer experience at key merchants. Venmo checkout will now be used on Amazon in 2022, which is huge and will only lead to more volume on the PayPal network and probably more users. Previously reliant on eBay, which is what it was spin out from, eBay is now only 3% of total revenue and shrinking. It was 7% the year prior. Year-over-year growth of 13% for the entire company, but 25% excluding eBay. Absolutely excellent at this scale. You can see from the right-hand side that only improving the relationships with these customers. They've launched Pay with Venmo with Booking.com recently in quarter Q3. Absolutely excellent, and it's only increasing. So looking at the financial situation of the company, I like to look at the balance sheet first when I'm analysing most businesses. Cash debt is strong, but historically weak. But this is not the best position PayPal has ever been in a cash to debt situation. But PayPal is a very acquisitive company. They just bought Payly, the Japanese buy now pay later service, so this should be no surprise. Cash debt at 1.49 is healthy enough to be not to be concerned. This is well covered by earnings with a debt to EBITDA of 1.33. Altman score of 3.53 showed this is a safe company, nowhere near financial distress. That cash to debt number is completely fine by me. They can pay off all the debts and still have roughly a third of their cash remaining, so that's fine. PayPal, from a profitability standpoint, is very strong. Net margins of 20% is absolutely excellent historically. Not perfect for the industry, but that they're up against a lot of really, really strong margin businesses like Visa and MasterCard. Net margins of 20% means to take home 20 cents of every dollar of revenue after tax. This is really, really strong, and it's part of the reason why they can be acquisitive, and they will continue to be acquisitive and heavily invest in their own business, is because they have such a strong margin profile. Return on equity percentage of 24% is absolutely excellent for the industry and is right on top of PayPal's historical comparisons. Return on assets of nearly 7%, again, excellent for the industry and excellent historically for PayPal. So this is a company, profitability-wise, that is really firing on all cylinders, regardless of its industry comparisons. Versus its own comparisons, it's doing absolutely tremendous. Whenever you're analysing valuation, of course, the first metric that jumps to mind is the PE ratio. Trailing PE of 46 and a forward PE of 30, just under 34. Again, this is perhaps a bit stretched, particularly versus industry peers like MasterCard and Visa. They're around the same numbers, if not a bit lower. However, versus PayPal's historical valuation, these are exceptionally low. Currently, the company trades at an EV to EBITDA of 32, which is exceptionally low. And that is really the point here, is regardless of the numbers versus the industry, which are kind of on the high side, this is because of PayPal's historical growth numbers and its quality as a business. This is a company that's growing 25% year over year on bad years, and historically this is as cheap as it's been for a long time. The next step in my valuation process is trying to work out intrinsic valuation and a fair value to pay based on that using a discount and cash flow method. This intrinsic valuation is essentially the number that if you're all known about the future and could predict all the cash that a business will give you between now and Judgment Day, this is the value that you'll be willing to pay. So I've taken a 25% earnings per share growth. This is in line with the 5-year growth rate of 26.5%, and this is also in line with the current growth rate post eBay today of 25%. I think this is a fair metric, and I think eBay I think PayPal can do this for the near future. Total addressable market for PayPal is absolutely huge and expanding rapidly at a compound annual growth rate of nearly 20%. So this to me seems extremely plausible. I've used an 8% discount rate for the overall long-term gains to the stock market and a 4% terminal growth rate for why I expect PayPal to get roughly population growth. So using that and a today's stock price of around $190, this gives a fair value of $248, and that's a margin of safety of 23%. This to me seems like an excellent buying opportunity purely based on this for PayPal stock at these prices. The final stage of my intrinsic valuation calculation is doing the same discounted cash flow for the free cash flow numbers rather than earnings per share. I often like to compare these. I've used a 22.5% growth rate, which is the 5-year growth rate of PayPal's free cash flow percentage. So again, using the same discount rate and the same terminal stage growth rate, this gave a fair value of $211 and a margin of safety of 9.44%. To me, this is approximately fair value, 10% above the stock price today. I consider this essentially a rounding error, and I think this is approximately fair value based on free cash flow basis, because a 10% margin of safety really isn't much to write home about in my opinion. So PayPal seems fairly valued with a decent margin of safety, not huge. So does its valuation factor account for its growth? Absolutely not. Compelling valuation for its historical values. Total addressable market is in the trillions and expanding, and it's very hard to imagine PayPal and particularly Venmo being small in the next 10 years. I think this puts PayPal firmly in the value stock range. Its growth is being not accounted for whatsoever. For me, this is a great opportunity to buy a fantastic business, growing at 25% a year and expanding. Particularly, I think is massively underrated is the growth prospects of Venmo and how that appeals to the younger generation. Price is of course imperfect, and I would like a slightly larger margin of safety, but of course, as Buffett says, it is better to buy a wonderful business at a fair price than a fair business at a wonderful price. I think PayPal is absolutely a wonderful business with long-term tailwinds at a reasonably fair price. It's currently a $250 billion market cap company. I think in the not so distant future, this will be a $1 trillion stock in the future with good execution. If for anything based on its moat and its total addressable market size alone. So with that, I'd like to say thank you, and that this is of course not financial advice and you should do your own research. And to please like and subscribe if you enjoyed the video.